We all know when interest rates rise, the cost of borrowing goes up, and that makes debt investments unattractive. But did you know that there are ways to profit from rising interest rates? Now, in this video, we'll tell you about one such option that would ensure a higher rate of return even at a time when interest rates are headed up. But first, do subscribe to Money Control channel and don't forget to like this video. Let's first understand what floating rate bonds are. We all know that bonds are debt instruments that work on the principle of loans. Let's break it down a bit. A company issues bonds to borrow money from the lender, who is called the bondholder. The company promises the lender a regular predetermined interest rate on the principal amount. In bond terms, this interest rate is called a coupon. However, some bonds do not have a fixed coupon rate. The rate on some bonds fluctuate based on several predetermined benchmarks. These types of bonds are known as floating rate bonds. Floating rate bonds have a variable rate that resets periodically. This means that if the prevailing benchmark rates are high, then floating rate bonds will give higher rate of interest. The frequency at which the yield of a floating rate note resets can be daily, weekly, monthly, or every 3, 6, or 12 months. Let's understand floating rate bonds with the help of an example. RBI issued a floating rate bond in 2020 with interest payable every 6 months. The interest rates will be reset by the RBI every 6 months. The benchmark for this floating rate bond is 35 basis points higher than the prevailing NSE interest rates. The repayment tenure for these bonds is 7 years from the issue date. The interest will be taxable per individual's income tax slab rate. The current interest rate of NSE is 6.8%. Thus, the interest rate for RBI's floating rate bond is 6.8% plus 35, which is equals to 7.15%. Also, any changes in the NSE rate can directly impact the interest rate of these bonds, which can be seen every 6 months. Now, when should you buy floating rate bonds? Now, the best time to buy floating rate bonds is when rates are expected to rise. Therefore, now may be a good time since RBI is expected to raise interest rates further to tame inflation. Let's look at some advantages of floating rate bonds. They are less volatile as coupon rates are adjusted to prevailing conditions. They offer higher yields compared to regular or fixed rate bonds. They are safe as there is no credit risk attached to them. Now let's also take a look at some of the disadvantages of floating rate bonds. The returns won't be fixed. If the interest rate falls, so will the interest earned by you since they are linked with the benchmark rates. Also, credit risk arises in corporate issued bonds when the borrower is unable to repay the principal and interest rate amount. As a result, bondholders may experience a loss related to their investment. To reduce this risk, they can invest in high-rated bonds or choose government-issued bonds with zero default risk. The coupons that you will get at periodic intervals will be taxable as per your IT slab. You can only exit from floating rate bonds after their maturity at the end of 7 years. Now, how can you invest in a floating rate bond? For government-issued bonds, firstly, you have to register on the platform with your KYC documents. After verification, you can select the bonds available for subscription. Next, you have to make the online payment from the bank linked to your Demat account. You will receive the bonds in your Demat account or available on the RBI Direct platform. They can also be purchased from the branches of nationalized banks or any other banks that have been specified by the RBI. For corporate issued bonds, you can buy individual floating rate bonds through a broker, or you can invest in mutual funds that invest only in floating rate securities. Some of these bonds are also traded over the counter. The bonds can also be bought through the stock exchange in the secondary market. Each bond has a script code, just like shares. With the script code, you can check the current price of these bonds. Also, the bond yields are available on the exchange websites. Moreover, when corporations issue these bonds, it is essential to check the credit rating before investing in them. This helps to ascertain the creditworthiness of the issuer. For more such updates, do subscribe to Money Control YouTube channel and also don't forget to like this video.